Welcome to Sarder TV, an idea-sharing platform founded by Russell Sarder, who's an author, investor, and the CEO of Netcom Learning. We're thrilled to have internationally recognized M&A expert Mark Sirower join us today. Mark is a principal at Deloitte Consulting. He's also an adjunct professor at NYU, and he's written a new book called The Synergy Solution, and he's here to tell us more. Mark, thank you so much for joining us today. It's great to have you here.
Thank you, Vishali. Nice to be here.
You've been with Deloitte Consulting for over 14 years now.
Around 15 years,
wow.
Yeah.
And prior to that, you were at PwC and BCG. Tell us a little bit about your career journey and how you got to where you are today.
I'm going to take you back before that, because I think that's really where my journey really started, was when I moved from Cleveland, Ohio to do my PhD in finance at Columbia Business School. And that's where the M&A journey really started. And you get through the coursework of a PhD program, and then you have to start looking at topics. And I started the program in 1988, and we were at the height of the 1980s merger wave. And it was the emergence of private equity, corporate raiders, and hostile takeovers, and there were full-page ads in the papers, regularly about this big deal and this hostile takeover. And so surrounded by M&A, and so M&A seemed to be sort of an interesting topic. And as a doctoral student, you really stand on the shoulders of giants that came before you. And that period of time was just this explosion of really interesting ideas. And if you don't mind, I'll go through some of them because they're all very connected. And as I thought about talking with you today, it sort of sent me back to what got me started. So out of the 1970s, and I'll be a little academic first, but out of the 1970s was, for me, out of the industrial organization economics literature, was contestability theory. And what was the idea about contestability? And it was, if everyone had the same resources and all investments were easily reversible, you could hit and run any market. There'd be no excess returns. It'd be perfectly competitive or perfectly contestable markets. I'd said, oh, all right, so that means, and by the way, today we call that, when it's difficult to contest markets, we call it economic moats or strategic moats. That's the term, but it all comes from contestability theory. So I'm reading the industrial organization economics literature, and then comes along 1980 Michael Porter and competitive strategy. And what he did was he popularized the idea of industry structure. And then he comes 5 years later with competitive advantage, that companies have to look at their value chains. This is all happening during the 80s. It was also the time, was the rise of the shareholder value movement and discounted cash flow. And that was rapidly followed up in the 90s with economic value added and EVA and EVA leaders. So we had all this work on value. And also at the same time in M&A, you had the organizational behavior literature talking about culture clash, change management. Philip Mervis and Mitch Marks did the merger syndrome. So there was all these ideas going on. And then comes 1990. The core competence of the corporation, Gary Hamel and C.K. Prahalad. And then this book, still one of my favorite strategy books of all time, Commitment by Pankaj Gamawat. And the resource-based view of the firm, capabilities. So you have all these things that are sort of happening at the same time. And in finance, there was an explosion in M&A research. 1983, Journal of Financial Economics, which led to a flood of articles and research across lots of disciplines on event studies, like what happens to the share price of the acquirer on announcement. So all these things were kind of swirling around. And I'm sitting there as a doctoral student kind of taking this all in, and I'm going, something's missing. You have these separate literatures that don't really talk to each other on a problem that's clearly multi-divisional or multidisciplinary. And in a doctoral program, you're supposed to focus on one. And I just, like I said, I came from Cleveland, Ohio. I was just a bright-eyed kid. My dad was a traveling salesman. So, I'm looking at this and I'm trying to make sense of it all. And I started to ask a bunch of questions. The first one is, this is a game. Like, you're paying up front for some distribution of outcomes in the future. There's a game being played. And then I started to ask, well, what really is overpayment? Because we talked about the winner's curse and the winning bidder overpays, but what does that mean? And what's the role of the acquisition premium when you pay more than anybody else in the world thought that already existing set of assets and technologies was worth? And I started to ask, well, what if these things we blame on culture or bad integration, what if these deals were dead on arrival? What if the price you were paying was so great and the performance improvements that were required were so great that nobody in industrial history could make it work? You know, and I started to look at these connections. And then just the issue of market reactions. What does it mean if your share price goes up 10% or down 10% on announcement? What does that mean? Is this a good forecast? And then it was the issue of merger waves. What does it mean to be in a merger wave? What is, you know, in economics we talk about merger waves as concentrations of M&A activity, but in reality they're waves of activity. What's going on in a merger wave? You know, is it the case that companies that hadn't been doing deals are now doing them? So you're injecting inexperience into the market? So that's really what got me going, and so I did my doctoral thesis on M&A performance, and that led to my first book 25 years ago, The Synergy Trap. So that's a little journey, and then I joined BCG, which was just a great place to innovate, and I got the chance to commercialize a lot of these ideas on M&A strategy, post-merger integration, structure, valuation, shareholder value, and learned a lot about consulting. I mean, I didn't know anything about consulting, so I learned the consulting craft, and then I had a chance at PwC to start a group from scratch, and so I built a deal strategy group there. And then I had the opportunity to join Deloitte going on 15 years ago, so that has stuck, and it's been really wonderful. But it was in a much bigger organization within a big consulting firm, launching an M&A strategy and commercial diligence practice.
So tell us a little bit more about that practice and your role as a partner.
Oh, sure, yeah. So, well, first of all, going into a big organization when you haven't even proved the concept is, you may have proved it someplace else, but you haven't proved it there. So it was pretty challenging for a while, and you know, our natural channels were our M&A transaction services where they're doing financial diligence. And so it was, you know, essentially how do we add M&A strategy, commercial diligence to things that they're already very successful at doing. But you know, once we proved the concept, and then the floodgates started to open, and that was a good feeling. There was a lot of demand, and you know, also when I got there, we didn't have any people. We had just a few people, a lot of smarts, but hadn't really done, you know, hardcore commercial diligence. And that bench grew, and that's probably been, for me, has been the most rewarding part of the last 15 years, is the young folks, people that I've had a chance to work with. They've just been terrific, whether it's on the actual client work, or I do recruiting at NYU, so my recruiting teams. It's been probably the most rewarding part, to watch that practice grow and develop, and the talent just get better and better over the years.
Tell us a little bit about M&A activity in today's market. What are some things that you're seeing?
So one of the things we know about M&A is that M&A activity, and it's been this way through the last 4 waves, M&A activity is correlated with rising stock markets. There's a lot of optimism. Rising stock markets cover up mistakes. You know, it's not till you go back and you industry adjust or peer adjust performance that you see them. And you know, the other thing is that what starts to happen, deals get bigger. That's the other big one. You start to see the deals getting bigger. The number of deals last year in 2021, over $1 billion in size, doubled from 2020, number of deals. So we had over $5.5 trillion of announced deals last year. Just 2% of those make up 65% of the value. So that's what we start to see in a merger wave. And it is, I'm not a soothsayer, but it is starting to look like the beginnings of a wave. And so what starts to happen for companies, as you can imagine, deals are swirling around them. Their competitors are looking at deals. It's one of the first things we do in M&A strategy is let's take a look at what your competitors have been doing over the last 5 years. So they're surrounded by deals going on. And the other thing we see then is, because how do you get a merger wave? Companies start doing things they weren't doing before, or active acquirers start doing more or bigger deals than they were doing before. That's the only way you can get that increase in activity. So you start to see a lot of reactive behavior. So for example, if you see a company wants to do a deal, one of the first things we ask, why weren't you looking at it 6 months ago when the market was 5,000 points lower? You know, you start asking, why wasn't that a good deal a year ago? Now, maybe it wasn't available and that sort of thing, but so we're living in really interesting times right now, and the numbers are staggering.
Tell us more about some of the trends that you have been seeing over, you know, the last 10, 15 years, and sort of what you expect or what you kind of see trends being in the near future?
We do CFO surveys annually. And I was just looking through these, and a couple of things jump out at me. Number one, it's around between 40 and 50% of companies expect over the next 3 years for 10 to 30% of their growth to come from deals, to come from M&A. So all signs are, again, as long as the markets stay strong, there's all signs that this is going to continue, again, with a big if. Because market movements make a big difference. We can talk about that a little bit. The other thing, without all I said about merger waves and reactive behavior and that sort of thing, about 75% of companies are sticking to their core. But that's a pretty good, it's a reassuring sign, because if you asked that question 10 or 15 years ago, they're interested in adjacencies and this sort of thing. And one of the things we say in M&A strategy is that today's adjacency is tomorrow's core. So when you start moving into adjacencies, you may be facing competitors you never competed with before. So those are two things that I think are very interesting that we're seeing now.
And you mentioned market movements have an impact on this.
Huge impact. I mean, think about, if the Dow were to drop significantly, let's just say the markets were to drop significantly, what happens to deals on the table? What happens to prices that were negotiated? If it's a stock deal, the value of the deal's gone down dramatically, so the seller's not happy. And if the seller's values drop dramatically and the buyer is paying cash, for example, I want to pay the same amount. So unless they're willing to pay an even higher premium. So it has dramatic effects on deals on the table, for sure.
Back in the late 90s, you wrote a book called The Synergy Trap. Tell us about what that book is about.
I told you about what the journey was. So that was sort of the outcome of the journey. And first, M&A is different. M&A is a different capital investment. That was a big thrust of the book. What's different about M&A? You pay it all up front before you even get a chance to touch the wheel. So that cost of capital clock starts ticking right on day one, whether you want it to or not. So that you can't divert the funding, you can't stop the funding, you paid it, and it gets paid all up front. So it's just that makes it unique. The second thing was, once you pay a premium that is more than anybody else in the world thought that set of assets was worth, you've created a brand new business performance problem that not only didn't exist before, nobody expected it. So it's a bit of a shock to the system. And if you allow me, if I could just give a quick example of what that means. If you looked at a company that had, let's just say, $40 million of net operating profit after tax, and let's just capitalize that at 10%. So it has $400 million of what we would call current operations value. In other words, if the business never got any better, it's worth $400 million. But it's trading in the market at $1 billion. So that must mean there's $600 million of future growth value, or expectations of growth already built into the company. If you go ahead and pay a 30% premium for that $1 billion company, or $300 million, where does that $300 million go? Your current performance hasn't changed. So you're layering on $300 million more to that $600 million that was already there. So now you have $900 million of growth value. That's a shock to the system. And that's the show. Like for me, there's an old saying, culture eats strategy for breakfast, or things like that. Finance, that's the show right there. It's the performance challenge you're setting up. And then the third is, once you start doing the integration that's so essential to making a deal work, you jack up the exit costs. It's very expensive to unwind mistakes. So M&A is a very different capital investment. And then once you see that, well, then the traps just sort of become really obvious, like a failure to understand the performance trajectory that's already built into the target company, and yours, quite frankly. So what's the growth that's already expected? So if you don't understand that, it's going to be very hard to think about synergies, which are gains over those standalone performance expectations. And then when you get to synergies, it's a failure to think about them in competitive and financial terms. They don't come for free. Every synergy has a cost to get it. And if you think about synergies in competitive terms, you have to say, well, what am I doing differently? Like, how am I going to compete better, whether it's on the revenue side or the cost side? So, it begs the question, and it's if but for the deal, what is it exactly because of that deal that allows me to be a better competitor, serve my customers better, et cetera? And then finally, do I fully understand the promises that I'm making? This premium's a shock to the system. And so just telling them, well, we'll get $1 billion of synergy sometime over the next 3 years, that's not satisfying to investors. And you can see why that would lead to kind of negative market reactions, and we can talk more about that. So that was really the thrust of the Synergy chapter. Very descriptive book versus the Synergy Solution, which is a very prescriptive book based on the challenge. And we start out with that as the first chapters. What's the problem we're solving for?
Tell us about your new book, The Synergy Solution. Tell us what that book is about.
Well, the Synergy Solution is a rather, as we say it, it's a rather heavy bookend to the Synergy trap. But it's after 25 years of experience, and with Jeff Wyron's my co-author, you know, between the two of us, we have 50 years of experience. I mean, it sounds like a line, but we do. We have, I've worked on hundreds of deals. Jeff's worked on some of the most iconic transactions. And it's essentially, you know, what have we learned over the years that address how you solve this problem? And I think what's very unique about the book, and it's not as if there haven't been M&A books before. There's lots of M&A books, hundreds, thousands of articles on M&A, is we really focused on the connections, because it's a very connected problem. Just my journey as a, you know, as a student, looking at the different literatures, you could just start to see those connections. And so if I describe it at a high level, it's the connections, it's the end-to-end connections along the M&A experience. It is an experience. M&A is an end-to-end experience. And it starts with M&A strategy and through diligence and valuation, announcement day, which is I think one of the crown jewels of the book, and then sign to close planning and post-close execution. But I think if I were to sort of summarize what holds the book together, there are 5 major themes. The first one, which we've talked about, M&A is a different capital investment, and that transcends the book. Second is that you have to know what you want and why and how you're going to create value. And that's a theme that starts with M&A strategy, and you'll feel it all throughout the book. The next one is you have to understand the promises you're making for the reasons I've said, and like what exactly are those promises? And so when you do a DCF, that's great. You may come up with this value, but what is it? Let's flip it on its side and take a little bit different approach, the sanity check, the DCF. And then what are the connections that have to be made across stakeholders? How are you going to communicate? And again, communication start right from the very beginning. And then, of course, how are you going to deliver on those promises? You know, what are the structures and governance and cadence and et cetera that you need to have in place so that you actually deliver on the promises? And you know, one of the themes in M&A, once a deal hits the table, time is not on your side. The time you have time is when you're figuring out what you want, understanding your markets, talking to customers, and you know, and so on. But once a deal hits the table, time's not on your side, and a lot of companies waste a lot of time before they announce a deal and immediately after they do.
Can you give us an example of that?
What does it feel like?
Yeah.
Oh, sure. Well, if you're a sort of stereotypical reactor company, a deal hits the table, you scramble a team, you say, yeah, that's sort of, we have a lot of ideas for growth. Yeah, that's sort of consistent with something that we had in mind. Our competitors are doing deals. We're being approached by bankers that we have to do something or we're going to be left without a dancing partner. So you spin up a team. You've got 3 weeks to do the valuations, the diligence, although the valuations will, in many cases, have been done for you. So you've got to test the assumptions that are in those valuations. And you reach an agreement. You announce the deal shortly thereafter. You hope, well, you know, that's the zenith of attention a deal's going to get. And then they wait to start doing sign to close planning. And that deal is likely to close 2 months, 3 months. Maybe if it has some regulatory issues, it could be slightly longer. But you don't have a lot of time before that deal closes to start delivering on those promises. And you can see the connections. You can see how those connections start falling into place. So at a high level, that's what the book's about. And it's a lot of nuance throughout.
You also mentioned that there's a lot of lessons in a successful M&A, but trust is a big factor. Yeah. Tell us more.
So just the way I said that the finance part of it's like the show, that's really the guts or the underpinnings of the problem you're trying to solve for. The way I like to say it is you're building the tapestry of management credibility. And I think when you say that to executives, they kind of go, right, the tapestry of credibility, right. I have to build trust with my investors because I'm announcing, in many cases, the biggest capital investment I've ever announced before. I have to build trust with my customers because what's in it for them? And when a big deal gets announced, what do competitors do? They go after your best customers. They tell them, oh, it's going to be a disaster over there. They don't know what they're doing. They offer them deals, so they'll try to poach your best customers. And in employees, that's the group, we talk about culture issues, but culture starts at announcement. The words you say are very important to employees, because what have you done in a deal? You've essentially knocked them down their hierarchy of needs. They're kind of minding their own business. They're self-actualizing, and they're going home, and they had sort of a career path in mind. You knew what they were living. Well, you bump them down real fast to their safety needs. Do I have a job? Do I have to move? Are my benefits going to change? So they have a lot of questions. And a lot of things can't be answered right away, but you have to let them know when they will be answered. If you say we're going to announce a new organizational structure in 4 weeks, announce the new organizational structure in 4 weeks. And the board, trust with the board. So trust transcends this sort of tapestry of management credibility.
What's the evidence for shareholder value in M&A in today's market?
Great question. This is something that has been studied for decades. One thing I think we just have to dispense with, and it's a statistic that we still see, and you still see it in prominent articles, they'll say all studies show that 70 to 90% of deals fail. It's not true. We got to get rid of that. So I've done studies before, and then the Synergy Solution, we looked at deals over 24 years, three merger waves. We looked at over $5 trillion of deals, over $1 trillion of premiums. And if you look at it in an announcement, based on what investors tell you, it's about 60% negative, 40% positive. So about 60-40. If you look at it on the 1-year returns, it's about 56% negative. So I'd say the number is somewhere between, it's safe to say that it's about a coin flip, somewhere between 50 and 60%, which is a good news, bad news story. And we can go on from here if you want to talk more about the evidence. But yeah, so I think that was kind of the starting point of our study, and consistent with the literature, on average, again, we all talk about M&A studies, it's always on average, but on average, acquirers underperform their industry peers by a bit, and it's about 60% negative market reactions, 40% positive. But that's not really the story. Does it really matter if it's 60-40 or 50-50? It's interesting, but at least it's consistent with past literature, at least our findings. Then you get to the issue of market reactions, like, do they matter? And there are still CEOs that say, well, you can't do something big without taking a hit to your share price, or all deals go down an announcement, or market reactions don't matter. And if that's the case, this is where we de-average in the study. If that's the case, if you look at the positive market reactions and track them over time, well, if they didn't matter, they should trend to zero. And the negative market reactions should trend to zero if market reactions didn't matter, and they don't. So we divided reactions into positive and negative portfolios, tracked them over time, and the positive market reaction portfolio stays strongly positive, the negative reaction portfolio stays strongly negative. So market reactions matter. And that's something that financial economists had sort of started to say a long time ago as well. So we're sort of confirming that, but in a popular way, market reactions matter. And then you get to the real story, which I think is most important for practicing executives. And that is, if you start out with a positive market reaction and deliver and persist, we call those persistently positive companies, you do great. And if you start negative and stay negative, if you confirm that initial negative forecast by investors and stay negative, you do pretty badly. There's a 60 percentage point difference, not just 60%, 60 percentage point difference in returns between the persistently positive companies and the persistently negative companies. And while initial positive market reaction doesn't necessarily guarantee success, a negative market reaction, very tough to turn around. About 2/3 of companies that start negative stay negative. And in stock deals, it's even worse. It's more like 75%. So, you come out of that, and this is where it's important for executives. When we talk about this with our clients, I think they agree, I'd rather start with a positive market reaction than a negative one. And so if that's true on announcement, think about all the work you have to do before you get there. And that's how important market reactions are, and how announcement day is so connected to the work that came before or should have come before, and the work that has to come after to deliver.
How do you control for that in your planning? is that positive market reaction? Is that something that you prepare for? Is that something that you can sort of spin it so that you're sort of ensuring that you're going to get a positive market reaction?
Yeah.
Or is it just something that's
left
up to the market?
You're asking the kind of question about announcement day that has been asked for sort of decades. So what can I do? Well, the thing about spin, you might get a positive reaction, but if you don't deliver, it's going to go away. So for our audience, think of the tests that a good investor presentation has to pass. And we spend a lot of time on this. And the first one is, are you giving them synergy numbers that are trackable? First of all, defendable. Does it make sense? And are they trackable? Markets hate when you come and say it's $1 billion of cost synergies and sometime over the next 3 years. That's not going to work. So and if you see the most successful investor presentations, they'll break it down into trackable kind of numbers that then can be reported on, and they will give a timetable for it. The best are when they say, we're going to get all the synergies and we'll get to our run rate by the end of the first year. That's a great sign of confidence if they deliver on it. The typical good investor presentation will show a 3-year ramp up to get to the run rate that justifies the premium. But that's the first really important thing, is it trackable and defendable? The second one, we said culture starts at announcement. Are you injecting more uncertainty into your workforce? That those investor communications, their employers are listening to. So you have to, to the extent that you can announce new leaders, the extent that you can talk about changes in your operating model, like how you might be going to market different. I'm oversimplifying it a bit, but things where you say, okay, I get a sense what's going on here. Because the most important thing for your employees is you need to calm them. And we have an approach we call calm, spark, inspire. The first thing is you have to calm them. You have to address their concerns. And then the third test is if you capitalize the benefits, does it get you back to the premium? The worst investor presentations, and you just have to wonder how they got out of the boardroom. If you just take the synergy numbers and capitalize it by a cost of capital, it doesn't even get you to the premium. And you look at these deals and how much do you think they drop on announcement? Pretty much the difference between what they said, the capitalized value of what they said, and the premium. So those are the things that, now, to answer those questions, you got to do a lot of work. You got to know in the M&A strategy phase, what is it that I want? What are the assets that are most important across a whole universe of assets? And when I'm doing diligence, it's not just that diligence is about a go or no-go decision. That diligence is supposed to either be giving you inputs to your valuation or testing somebody's assumptions that got put in the valuation, because assumptions in a valuation become promises once you pay it. And the other part, why diligence is so important, is you're doing your early integration roadmap. It's sort of, a catchphrase I use is, post-merger is the wrong time to be doing pre-merger planning. Pre-announcement day, you should sort of have a view, if you're going to have significant cost synergies, what's going to come first? What functions are going to, where's it going to come from? What are the one-time costs? Severance, sunsetting, lease arrangements, all this. When are you going to incur those one-time costs? Are there going to be interdependencies across functions or businesses as you put these things in place? Or how are these going to be phased? Should know that before announcement day.
I know we talked about the importance of shareholder value in M&A activity. And I know today the market also looks not just at shareholder value, but they're also looking at customers and they're looking at employees. And that all gets factored in now into overall market value of an organization, for example. So are you seeing that more when it comes to valuing M&A activity?
ESG issues and the scores that companies are just like shareholder activism scores, back 10, 15, 20 years ago are important. Now ESG scores are very important. How that impacts market value, that I can't say exactly. I'm still kind of dyed in the wool. Here's what something is worth based on, here's the capital I've employed, here's the charge I'm going to have to take on that capital, and can I achieve that kind of performance? But definitely it's in boardrooms now. It is definitely one of the things that's being considered actively when we look at targets. And our own companies. They're in our own clients.
Can you talk a little bit more about how investor sentiment impacts future returns?
Sure. So the evidence now we can say is that a positive market reaction if you deliver is great. And and you'll do even better as you confirm those forecasts. Think of investor reactions as forecasts. So that's where market sentiment is really important. You're on announcement day, investors are going to make a forecast of whether this is a good thing or bad thing for your shareholder. And so think of the after effects of that. If you're an employee and you have your pension assets invested in your company's stock and it drops by 10%, that impacts employees. Employees and shareholders have a lot in common around that. So it's one of the dirty little secrets of negative market reactions. It really sets a tone that people are living with, like, okay, well, our investors don't believe you. And now we might be saddled with synergy targets that are just nonsensical, because that's what happens. Imagine you're sign to close planning. One of the things you do in a workshop, your kickoff workshops, is you're assigning synergy targets to the work streams that sit under an integration management office, which we could talk more about. If you've overpaid for a deal, those targets are going to be nonsensical. And if you get a negative market reaction, it's sending a signal that we're off on the wrong foot. We're down 7-0 in the first inning. So it definitely, and customers the same way, which gets back to the point you said about trust, or asked about trust early on. Investor sentiment, it's not just that your stock price went down, it's affecting perceptions from a lot of people.
So what would you say are some of the key things that executives need to know to avoid the synergy trap?
That's what the synergy solution is all about. For us, it starts with M&A strategy. If you're just reacting to deals, then you're just playing this constant game of playing not to lose. It's just you're doing diligence and more diligence, and you're just playing this game of not to lose. Successful acquirers play to win. They have to make a lot of difficult choices, and that's the hardest thing for management. There's a universe of deals that you could do, and the interesting thing about merger waves is, and we've seen this over 4 merger waves now, there are also waves of divestitures and spin-offs. So there's lots of assets in the market, and the first thing is don't be a reactor. Understand what are your most important pathways for growth, what businesses have earned the right to grow through M&A, or what businesses might benefit. But you can't do everything. What businesses might benefit from additional capabilities, but that's the first step. And that involves a lot of choices. And the way we say it is, M&A strategy is putting in place an orchestrated process of making strategic choices. That's so you know what you want. And then once you've prioritized what businesses might be most appropriate for looking at deals, you want to understand the universe of deals that's out there. And that's where screening comes in, and that's where you have to make choices about what are the most important screens. But number one, it's having a real identifiable M&A strategy. What are the most important companies? Do I have a watch list of deals? And this is the question we ask executives. They'll say, how do I know if I have an M&A strategy? And I'll say, well, what are the 20 most important deals that you're pursuing over the next 12 to 18 months? If you don't know what those assets or sets of assets are, you don't have an M&A strategy. And then you've trapped yourself into being a reactor. And the reactors, they got to compress time to do diligence. Then they'll, if they do diligence improperly or too short a period of time, they'll likely overpay. And then they'll delay the integration planning. They won't have a successful announcement day. They'll delay integration planning that should kick off, if not the day after, a couple days after. And they'll assign teams nonsensical synergy targets. Employees won't understand their role and their future in the company. And then you get to post-close execution, and people are vibrating in place. So
So you mentioned a couple of questions that executives should be asking themselves while they're putting together an M&A strategy. Can you just go through what are some of those key questions they should really be asking themselves?
Well, the first question is, what are the deals that we want? It sounds like a simple enough question, but what are the deals that are most important to us? The second question then is, well, what are the deals that we don't want? And you think, well, that's why you have to take this through this process. So if something comes up opportunistically, which can happen, at least you have a framework to go back to understand why you screen that out in the first place. So what are the things that are not priority deals for us? The third one is, what would we do if a competitor does a deal that could hurt us? And it's easy to talk about defensive M&A, but you have to keep your eye on those deals that might hurt you competitively if a competitor does it, because those might be auctions you need to get involved in. And the other one, I'm oversimplifying this a bit, but the other one is, what do I do if I don't close this deal? You know what? And if I do a deal, what's next? Otherwise, you're just looking at assets in isolation as opposed to portfolios of assets.
There's some key activities that you talk about in the book when it comes to financial, commercial, and operational due diligence. Tell us what the differences are
sure.
in these.
That's a good question. So financial diligence is about, for us, is the baseline. In other words, you strip out extraordinary items. You're trying to cast the business, what we'd say normalize what its operations look like. So they might have had a spike in sales, but is that sustainable? So we're looking at backlog and things. So it's really that financial diligence is very much backward looking to get a baseline that we're going to build forecasts off of. Commercial diligence is all about the revenue line, and it's testing those propositions of how we're going to serve customers differently. First of all, the stability of the target's current business, testing that, but then looking at how it's positioned in the market and what are the revenue enhancement opportunities when we put these together. And so, as we say, all the answers are in the market. It's all knowable. You just got to go out and find it. And that's the secret sauce of commercial diligence, is the primary research, either one-on-one interviews, shopper intercept, surveys. And so it's and this is really important because it's, first of all, do they want this new offering? What are their unmet needs? What are their satisfactions, dissatisfactions? What are they willing to pay for them? Why would they switch, or why did they switch from you in the first place? And so that is very much an outreach to the market. And on the cost side, it's getting both a top-down view, which is just based on benchmarks, what could be the opportunities of benchmarks of high-performing companies, what could be the opportunities for cost improvements. But then a bottom-up view as we look through this function by function, where are the opportunities, and assessing what the one-time costs are going to be. And I would just say one other thing. Most companies will tell you they have performance improvement programs in place. Don't mix those up with synergies. If it's already, first you got to diligence what they say they're supposed to do. Is that reasonable? Those aren't synergies, because that's already built into the price of the target. So don't mix up those ongoing performance cost takeout programs, cost transformation programs with synergies, because synergies are on top of that. So if but for the deal.
So in your experience, what have you seen that leaders or executives misdoing when it comes to due diligence that might prove detrimental in the process? That's
a really good question, and it's a little bit subtle. So successful acquirers are regularly doing diligence in the market, just as a normal part of business. There's a story I just feel like telling, but there was a boutique cosmetics fragrance company, and they just started to listen to their beauty advisors, and they listened to what their customers are telling them, and they were saying there was this particular product, they couldn't keep it on the shelves. They wanted more of it, so they made a bigger bottle, doubled the price, more than doubled the price, and they can't keep them on the shelves. And so my point is, successful companies in general are listening to their sales people, their sales force. They're looking at the data in their sales channels. So, but sometimes when a deal hits the table and you're looking at an offering that might be a bundled offering, it's some companies may need to refresh that, do almost some sort of separate tests about these new offers they might bring to the market, what they might price them at, and does it make their relationships with their customers stickier, less likely to switch? So that's one of the things we find. Sometimes it's good to do a diligence exercise, even if you think you really understand your markets, around the specific benefits that are going to come out of that target. That's a big one.
What are some key considerations that should be taken into account when it comes to valuations of an M&A deal?
Another great question. We've been talking about valuation since the famous 1961 Franco Modigliani, Merton Miller paper in the Journal of Business, where they showed the equivalence between discounted cash flow and what they called the investment opportunities approach, which later became known as EVA, or economic value added. So there's still no substitute for a discounted cash flow model, because it's theoretically makes sense, and think about what you're trying to do. You're trying to look at the growth trajectory in your revenue, the stability of your margins, your tax rates, and then the additional investments are going to be required either in working capital or CapEx. So those are the, that drives your free cash flows. From a DCF perspective, the sort of the, I don't know if it's the law, but my rule is don't mix up synergies with valuing the standalone company. It's a base case, and then the synergies are an overlay. And be very careful about what you start to do in a 10-year model. You might just smooth a little bit more revenue growth in years 5, 6, 7, 8, and then they're in a terminal value that's perpetual. So you have to be very, very careful about the small assumptions that you make in a DCF model because they're very sensitive to small changes. I think the big takeaway, and it's a consistent takeaway throughout, is don't mix up synergies with what's already expected. From an economic value perspective, and this is where, from an economic value added perspective, and this is one of the things we spend a lot of time on in the book and in practice, is whatever value you get there, kind of flip it on its head or look at it however you see it, look at the mirror image of it, and turn that synergy number into a 3-year ramp up. Like, given what you're valuing the synergies at, let's see what that looks like in a 3-year ramp up. And you might be shocked about what you're actually promising if you turn that into a 3-year ramp up to get to a level run rate over time.
So I know we've been talking about announcement day. You've been talking about the importance of announcement day. Tell us a little bit more about how important it is to really set that up and be proactive about it, what it takes to make it a successful day.
We talked about the tests of a successful investor presentation. Think of why announcement day is so important and the functions it serves. First of all, preparing for announcement day, if you think of it this way, preparing for announcement day is your last stop in diligence. You're asking the fundamental question, which is, how is this deal going to affect my share price and why? So the preparation for it is your last stop in diligence. And it's the fundamental question that boards should be asking. How's this deal going to affect our share price and why? The second thing is all the communications you do, the press release, the investor presentation, the conference call, any road shows you might do to support that, that's all fodder for other stakeholders. Employees are listening, customers are listening, suppliers are listening, regulators are listening. So what you communicate is fodder for everyone else's diligence. And then I mentioned earlier, culture starts an announcement. So understand that employees, this knocks them down their hierarchy of needs. So there are going to be a lot of questions. And so don't send expectations that you can't deliver on.
And it seems like preparing the organization for a culture change is equally as important as everything else that's being done to prepare for this. Tell us what needs to be done to help prepare for that culture change.
Yeah. And I know you're a HR and performance consultant, so you'll appreciate this. So it starts right after announcement day. And it's so easy to blame, say, culture clash on a deal that fails, retrospectively. But if you think of culture as shared values and beliefs and norms and behaviors and incentives, but how work gets done, well then that work has to start after announcement day. And even before, when you're thinking about the changes that are going to have to go on, whether it's your operating model or your org design. And so we think of it like this, across all employee groups. Where are there going to be changes? Because a lot of folks might not be impacted at all, so they need to know whether they're going to be impacted or not. So identify the changes. And that could be a customer service rep that's going to have 15 major changes over the next 12 to 18 months because they may have to do with a new CRM system, new products, new scripts, and so on. So identify the changes. The second is, what are we going to do to support those changes? Some of them might be simple things like learning new procedures. That could be a kiosk setup that they can do in their normal workday. Some of them might be big changes that require leadership visits to describe the changes. So it's understanding what the organization is going to do to support employees through those changes and their new roles for those that are impacted. And then it's making sure they're ready. So it's readiness checks, and there's a lot that can be done before close, but a lot of that will be after close. But then it gets into then you're into real change management.
What's the board's role in helping to avoid the synergy trap?
So the board's role should be big. And let's just think about it. I think of the board's role starting with what's their duty of care and the business judgment role. So what would an ordinary prudent person in similar circumstances, what would they want to know? Somebody, I'm from Cleveland, Dad was a traveling salesman, like, well, what should they want to know? Well, is this deal consistent with what we've said were strategic priorities? I mean, the most important deals should have already been on the board's agenda in case any of those had come live. How much shareholder value are we putting at risk? We call this SVAR, shareholder value at risk. How much shareholder value are we putting at risk? SVAR is different in a cash deal than it is in a stock deal. And because the fundamental question they're trying to answer is, how's this deal going to affect our share price and why? It shouldn't be a big surprise if your shares drop by 10%, on announcement. And then we get into the post-merger integration plan. Now, you're not going to have the whole plan laid out pre-announcement, but you should have a pack that goes through what are the major phases of the PMI, what are the top-level shaping decisions that hopefully management's already made before they get into sign and close planning, any major operating model changes, ERP system changes. Those decisions should be made early. What's called integration strategy, but what's the pacing? What's going to be integrated? What's not integrated? What's the tone? Is this going to be acquirer driven, or is it going to be, on the other stream, best of both? And who's going to make decisions? How's this going to be governed? And then you get into the structure. A board should know, what does the IMO look like? Who are the leaders of the IMO? And finally, the business plan. What exactly are we promising? And something that's trackable and defendable, because you're going to bring that to investors shortly thereafter. So those are the things. And I can go on, sort of on and on about board level discussions on this. But that's kind of the basics of it, which is how much shareholder value do we have at risk, and how are we going to deliver the value?
You've mentioned there have been 4 waves, or there are 4 waves of M&A.
Since the 80s, since I started to get involved, yeah.
Can you talk about what those 4 waves are, or what they've been?
So let me see if I could do this at a high level. The 80s was the hostile takeover wave, the emergence of private equity, activist investors, what we would call them today. And it was the era of the cash deal. The 90s were, if you think about how we started, you look at 1990, the Dow was around 2,000. By the end, it was 10 to 12,000. So it was just, nobody had ever seen anything like this before. So companies had currency that they couldn't have imagined just a few years earlier. Your company's doubling in value and doubling again. And so the 90s were very much the period of the big stock deal. And we probably had the worst evidence around the 90s. And then going into, I'll just take the last couple of decades, it's much more of a global business. There are still cash deals, stock deals, but a lot more hybrid deals. And I said global. If you look at the data from last year, $5.5 trillion of deals, U.S. targets represent less than half of that. So, over the last couple of decades, M&A is a global business in a way that it wasn't 20 years ago.
And what has the evidence shown in what makes deals fail?
What do the articles say? You didn't have a strategy, and you overpaid, and you didn't manage the cultures right. So that's what everyone will tell you. But it really is the nuance. It's making the difficult choices early on about what's the most important assets, portfolio of assets for your business that could be accomplished through M&A. And that really is defining what's the role of M&A in your growth. Is it 10% of your growth, 20%, 30%? That's a pretty important question to know before you start making the biggest capital investment decisions. The other thing I would say is that, are you testing, if you think of what do you come out of M&A strategy with? Propositions. Well, those propositions have to be tested. Now, you can either test them before a deal goes live, or you can make that as part of your ongoing diligence in the market. And then, diligence is not just about a go or no-go decision. It's about inputs to the valuation model and building your early integration roadmap. So that, when you get to the board's prepared to exercise their duty of care, what an ordinary prudent person would do in similar circumstances, and you deliver a successful announcement day, and then you're ready to kick off sign to close planning immediately after announcement.
So you've had a great career. You got your PhD, you went on to work for some great companies. What is some of the best career advice you've received? And what is some of the best advice you feel like you've given?
When I got to Deloitte, and I was struggling, I had great 10 years before that, and I had all this stuff and the synergy trap, but I had to prove the concept, and I had to get into the channels that Deloitte has to go to market. And I had this great piece of advice, and I thought it was kind of wishy-washy at first. Everybody says it, but they said, focus on what you're passionate about. And everybody says that. And I kind of focused on, I kind of took that to what am I good at? And an old friend of mine used to say, there's a difference between what you're good at and what you can do. You can force yourself to do other things, but if you focus on what you're really good at and find a way, find your path through that, that's just a better path. Now, it could have not worked out, but as opposed to trying to force yourself into something that isn't your core skill set. So that was probably the best advice that I got, and it worked. It really worked. The advice that I give, especially say, people that are in business schools, I always say take the hardest courses. When you're young, you can, if I fall down, now I'm going to be 60 next month. If I fall down, I'm going to break. When you're young, you can study harder than you'll ever get it. You just won't be able to do it as hard. So take on the tough challenges, make sure your horsepower as good as it can be, and take on the kind of projects. If you're in a consulting firm, take on the kind of projects you don't really want to do. You're going to learn so much. I can't tell you how important that is. We take really smart diligence folks on my teams and we put them in a PMI, post-merger integration. Maybe it's not as analytical. And they learn so much, and they come back, I can't tell you how much I learned. So that's the advice that I give younger folks coming up. Focus on what you're really good at, but then learn wherever you can.
Well, Mark, this was great. Thank you so much for joining us. I know our viewers are going to get a lot out of this.
That's great. Well, thank you, Vishali, for having me.
And we'll see you next time on Sarder TV.